Hello everyone, this is Group 4 and we're here to give a video presentation on cryptocurrency. Okay. So what is cryptocurrency? So what is cryptocurrency? Cryptocurrency, also called virtual currency or cryptocurrency, is digital money. That means no physical coins or bills, everything is online. You can transfer cryptocurrency to someone online without an intermediary, such as bank. The best known cryptocurrencies are Bitcoin and Ether, but new cryptocurrencies continue to be created. People could use cryptocurrencies to make quick payments and to avoid transaction fees. Some people might purchase cryptocurrency as an investment, hoping that it will increase in value. Cryptocurrencies can be purchased with a credit card or in some cases through a process called mining. Cryptocurrencies are stored in digital wallet, either online, on your computer, or on another physical medium.
Next, we'll move on to the history of cryptocurrency, the birth of cryptocurrency. The history of cryptocurrency is a fascinating journey that began before the emergence of Bitcoin. In the 1980s and 1990s, brilliant scientists and cryptographers embarked on a quest to create fully encrypted and secure digital currencies for the internet. One of the early pioneers was DigiCash, founded by David Shom in 1989. While DigiCash didn't achieve widespread success, it paved the way for future developments in the world of digital money. The rise of Bitcoin. In 2008, the investigator group on Satoshi Nakamoto published a groundbreaking document that introduced the protocol and a functional version of Bitcoin. January 2009 marked the birth of Bitcoin with the mining of its first block, the Genesis block, a flourishing ecosystem. Following the advent of Bitcoin, a wave of innovation swept through the cryptocurrency landscape. Litecoin emerged in 2011, followed by Ripple in 2012, each striving to improve upon various aspects of Bitcoin, such as transaction speed and energy efficiency. In 2013, Bitcoin's price soared to $1,000 for the first time, capturing the attention of the world and making a significant milestone for the entire industry. The ICO boom and regulatory challenges. The year 2017 witnessed an explosive growth in cryptocurrency market with the rise of initial coin offerings, ICOs. Many exciting projects raised capital by issuing their own tokens, attracting a surge of investor interest. However, alongside this boom, fraudulent activities also increased, highlighting the need for regulatory measures to protect investors and ensure market integrity. Next, we'll discuss about the difference between cryptocurrency and normal currency. The fact that cryptocurrency are digital is not the only important difference between cryptocurrencies and traditional currencies like Indian rupee. Cryptocurrencies are not backed by a government. Cryptocurrencies are not government issued like bank deposits. This means cryptocurrencies stored online don't have the same protection as money deposited in a bank account. If you store a cryptocurrency in a digital wallet or a wallet provided by a company, the company ceases operations or suffers a hack. The government may not be able to act and help you recover the money as it could with the money that is kept in banks or credit unions. The value of cryptocurrency changes constantly. The value of cryptocurrency can change every hour. An investment that may be worth thousands of dollars today could be worth only hundreds of dollars tomorrow. If the value goes down, there is no guarantee that it will go up quickly.
Coming to the how does cryptocurrency work? Cryptocurrencies are not controlled by the government or central regulatory authorities. As a concept, cryptocurrency works outside of the banking system using different brands or types of coins, like Bitcoin being the major player. Coming to the mining, cryptocurrencies are generated through a process called mining. This is the complex process. Basically, miners are required to solve certain mathematical puzzles over specially equipped computer systems to be rewarded with bitcoins in exchange. Coming to the buying, selling, and storing. Users today can buy cryptocurrencies from central exchanges, brokers, and individual currency owners or sell it to them. Exchanges or platforms like Coinbase are the easiest ways to buy or sell cryptocurrencies. Once bought, cryptocurrency can be stored in digital wallets. Digital wallets can be hot or cold. Hot means the wallet is connected to the internet, which makes it easy to transact, but vulnerable to thefts and frauds. Cold storage, on the other hand, is safer but makes it harder to transact. Let's come into the process called ledger. A ledger is used to record financial transactions. There is only one way to add changes to a ledger, that is by appending it with new transactions. Ledgers aren't unique to the cryptocurrency market. They have been used for many years before digitalization. However, when it comes to the crypto sector, a ledger is used to keep track of the balances and transactions of each party. As a decentralized system, each transaction involved a particular cryptocurrency is recorded on a single ledger, but there are numerous copies of that ledger, one for each person of the network. This is what mining is. This simply means that someone has configured a machine to process transactions from their copy of the ledger. There are currently 1 million or more Bitcoin miners worldwide. They will receive some Bitcoins in return for devoting your computer's processing power to mining. This is how mining works. Yeah, when we spend Bitcoins in a store, instead of checking with just one bank's record, the shop verifies the balance by consulting every computer on the network. Assuming we have enough Bitcoin, each computer gives the go ahead and then updates its own copy of the ledger independently. Since there are many identical copies of this ledger, it becomes easy to detect any suspicious activity. For instance, if someone tries to hack into a network computer and alter their ledger, the system will recognize the dispense discrepancy. This transparent and organized system ensures transferable transactions, making it more secure than fragmented record copy keeping. This is how cryptocurrency works.
Now let's talk about Bitcoin. Bitcoin is the most popular cryptocurrency that exists today. It was the first truly decentralized cryptocurrency. It was launched in January 2009 by a computer programmer or a group of programmers using the pseudonym Satoshi Nakamoto. Nakamoto's actual identity has been never verified. Going back to the history of Bitcoin and skipping through some minor events, the popularity and consequently price of BTC grew over the years. The first major crypto boom happened in 2017 and was followed by what we call now the crypto winter, a sudden price crash, and then a few years of stagnation. Today, Bitcoin alone is worth nearly $400 billion. The following are the important events in Bitcoin's history. Other prominent cryptocurrencies. Now, we'll start with Ethereum. Let's have a look on other prominent cryptocurrencies. Ethereum. Both a cryptocurrency and a blockchain platform, Ethereum is a favorite of program developers because of its potential applications like so-called smart contracts that automatically execute when conditions are met in non-fungible tokens NFTs. Ethereum has also experienced tremendous growth. From April 2016 to the end of April 2024, its price went from $11 to around $3,621, increasing 32.82%. Tether. Unlike some other forms of cryptocurrency, Tether is a stable coin, meaning it's backed by fiat currencies like US dollars and the euro and hypothetically keeps a value equal to one of those denominations. In theory, this means Tether's value is supposed to be more consistent than other cryptocurrencies, and it's favored by investors who are wary of the extreme volatility of other coins. Binance Coin. Binance Coin is a form of cryptocurrency that you can use to trade and pay fees on Binance, one of the largest crypto exchanges in the world. Since its launch in 2017, Binance Coin has expanded fast, nearly facilitating trades on Binance exchange platform. Now it can be used for trading, payment, processing, or even booking travel arrangements. It can also be traded or exchanged for other forms of cryptocurrency such as Ethereum or Bitcoin. Solana, SOL. Developed to help power decentralized finance, uses decentralized apps and smart contracts. Solana runs on a unique hybrid proof of stake and proof of history mechanisms to process transactions quickly and securely. SOL Solana's native token powers the platform.
How to invest. If you are wondering how to invest in cryptocurrency for the first time, the following 5 steps can get you started. First, understand and allocate investment. Comprehend the asset class and the need for investment. acknowledge the high volatility of the crypto market, allocate only a small percentage, 5 to 10% of the portfolio to digital tokens. Second, choose the cryptocurrency. Over 5,300 digital tokens are available. Bitcoin is widely traded, but not the only option. Research other cryptocurrencies that have performed well. Third, understand the cryptocurrency. Consider fundamentals, blockchain technology, accessibility, mining technique, community support, and intrinsic value. Fourth, choose the buying platform. Use dedicated cryptocurrency exchanges for purchasing. Expect fees for both buying and selling. Buy directly from exchanges or other peers selling their holdings. Understand that cryptocurrency trading is entirely anonymous. Fifth, store cryptocurrency. Use crypto wallets, hot or cold. Hot wallets are connected to the internet while cold wallets are offline. Wallets store private and public keys for accessing cryptocurrencies on the blockchain. Choose from desktop, online, mobile, or hardware wallets based on security and convenience. Sixth, securing your crypto wallet. Use a VPN for secured and encrypted online transactions. Data encryption ensures anonymity and protects against hacking. Some of the best platforms for crypto investment in India include CoinSwitch, best for beginners, CoinDCX, ZREX, Mudrex. Current trends. The cryptocurrency market is still growing today, despite of its volatility and a number of obstacles like technological problems and governmental restrictions. Blockchain technology is used in many other domains, such as voting and logistics. In addition to finance, innovation is facilitated by projects like Ethereum, which make it possible to create smart contracts and decentralized apps. The following are some of the hot and popular now. The following are some of the hot and popular cryptocurrency trends now. DeFi, decentralized finance. DeFi is all about creating decentralized financial systems using blockchain technology. It's like traditional banking, but without the need for intermediaries like banks. This trend is growing rapidly as it offers greater financial freedom, transparency, and accessibility. Stablecoins are cryptocurrencies that are pegged to a stable asset like gold or the US dollar. Stablecoins aim to reduce the volatility associated with cryptocurrencies, making them more attractive to businesses and individuals who want to use cryptocurrency for transactions without the risk of wild price fluctuations. NFTs, non-fungible tokens. NFTs are unique digital assets that represent ownership of a piece of content or item. They have been making waves in the art world, but the potential use extend far beyond that. Think of them as unique digital collectibles or even virtual estate. Central bank digital currencies, CBDCs. More and more central banks are exploring the idea of issuing their digital currencies. This could revolutionize the way we use and think about money and help make transactions faster, cheaper, and more secure. Regulation. As cryptocurrencies become more mainstream, regulators are starting to take notice. This trend could bring more legitimacy to the space, but it also comes with challenges. Balancing innovation with consumer protection is a delicate art. Sustainability. The impact of cryptocurrency, particularly Bitcoin, has been a hot topic. This has led to a trend towards more sustainable cryptocurrencies like Chia, which uses a different consensus mechanism that is less energy intensive. Layer 2 solutions. Layer 2 solutions are protocols built on top of existing blockchains like Ethereum to improve scalability and reduce transaction cost. They aim to address the limitations of the underlying blockchain, enabling faster and more efficient transactions. Layer 2 solutions such as Lightning Network for Bitcoin and optimistic rollups for Ethereum are gaining traction as scalability becomes a pressing issue in the cryptocurrency space.
Now let's have a look on the pros and cons. We'll start with the pros. Minimal transaction cost. Sending money online through a bank gateway is time consuming and expensive. On the other hand, cryptocurrencies come with little to no transaction cost as there is the commission levied is negligible. 24/7 access. Money invested in share markets or credited in bank accounts has a specific timeline for transaction. With cryptocurrencies, a person has 24/7 access to money without any specific timeline to transact or utilize the money invested. Unlimited transaction. With cryptocurrency, you can pay or send money to anyone, anywhere at any time, irrespective of the location of the other user. However, they should be willing to accept the payment in the said cryptocurrency. As there is no central authority to control or resist the transactions, you can make unlimited transactions, faster international transactions. With cryptocurrencies, the time taken to process a transaction is relatively low. If you are sending money online to another country, blockchain technology processes the transaction within seconds and in the most secure way. Now let's have a look on the cons. Highly volatile. Cryptocurrencies are one of the most volatile asset classes in the whole financial market. Although this volatility and the resulting price fluctuation allows investors to make profits, it can also force them to incur massive losses if the price fluctuation is negative. No literature. Unlike stocks, where you can do technical and fundamental analysis to understand the current trend and predict the future trend, there is no method to know cryptocurrency trends. As there is no literature, investors can't effectively analyze and evaluate the cryptocurrencies, resulting in highly speculative investing. No regulations. Currently, there are no rules, guidelines, or regulatory body to govern the working of cryptocurrencies. This has resulted numerous times in investors losing their money to scammers or cryptocurrencies that are made for raising funds for illicit activities. As you can never know who you are selling or paying to, there is a big concern on how the money is used on the other side. Cyber attacks. Everything digital is always vulnerable to cyber attacks. However, cryptocurrencies such as Bitcoin, Ethereum, etc., which are high in demand and value, witness significant attention from cyber criminals. In case of a cyber attack and there is no regulatory body, it becomes next to impossible to retrieve the lost money, which can force you to lose your personal data along with the invested capital.
Let's dive into the future trends of cryptocurrency. There are many expectations for the future of cryptocurrency. The price of Bitcoin is expected to exceed $100,000 per unit. Marketing will also take full digital form. It would have been easier to trade and invest. All changes will be processed and digitized. This is possible only when the help of the cryptocurrency. The need for cash flow is more important to a business than profit. Due to financial crisis, companies are unable to fulfill their current commitments. Consumers will be able to easily access financing in future, which would encourage microfinance. In Indian terms, the cryptocurrency and the regulation of official digital currency bill 2021 shows the future of the virtual currency market in the country. This shows the future progress of the company as a whole.
With this, we'll conclude our presentation. Cryptocurrencies hold the potential to significantly alter various aspects of our lives, from providing various financial services to the unbanked to challenging traditional banking systems. The impact of cryptocurrencies is vast and multifaceted. While there are risks and challenges associated with cryptocurrencies, their continued evolution and integration into different sectors could lead to substantial changes in how we conduct financial transactions and interact with the global economy. As this technology and its applications continue to develop, it will be important to address regulatory and security challenges to fully realize the benefits of cryptocurrencies. Coming to the bibliography, we've used a book by Peter D. DeVries, An Analysis of Cryptocurrency, Bitcoin, and the Future. This book provided valuable insights into the topic. Thank you.